thank you everyone for taking the time to dial in and have a listen this morning. So it is a super interesting time, I think, to talk about investing, talk about markets after what has been a pretty volatile but pretty exciting and hopefully pretty rewarding year for markets. So what I wanted to do was just give a quick intro to Shires and what we try and do, talk about what's happened with markets this year, and then talk a bit about what we're doing in the portfolio and how we're going to try and take advantage of all that. So starting with the intro, I think for any investment trust, what is really important is having a clear view of what you are trying to bring to the end client. And for Shires, our aim is very clearly to deliver a premium level of income, make that resilient and grow it over time, but also retain the potential for capital growth over time. And we do that by investing primarily in UK equities, but we are quite differentiated, and we differentiate in three ways mainly. The main one is having exposure to preference shares and fixed income, which makes up about 20% of the portfolio. We also invest in overseas equities to provide some diversification. And then within UK equities, we have a real size agnostic multi-cap approach, which means we have a lot of exposure to small and mid-cap companies in the UK market. And what we're trying to do is really focus on income generation for clients. And the table at the bottom there kind of shows you the way we think about the Shires offering, I guess. And although we worry about the benchmark, we see the competition for this for clients is really cash and bonds and other equities as well, because they are sources of income just as much as equities are. And why we think Shires works so well is because if you look at that table, equities over time, they don't quite offer at the moment the same yield as cash and bonds, but they do offer much better long run real returns. So with Shires, we're trying to give that equity capital return exposure, but with the premium yield to equities, but also premium yield to what you would get out of cash and bonds. And at the moment, when cash is a real competitor for us, particularly, I think, we want to maintain that difference, but we also want to make sure that with cash over time, you are going to see your capital deflated. You're going to lose money effectively. With an equity investment, you've got a much better inflation hedge, and the long-term return should be much better. And I would encourage anyone to read some research published by Deutsche Bank this week, actually, which looked at very long-term returns. And it sets out very clearly how cash is really not where you want to have your money. Equities are. And hopefully with the income as well, what we do is something that's really valuable for a lot of investors. Of course, the dividend and the income is the main outcome for Shires, and the preference shares is the way we deliver that in a slightly differentiated way to pure equities. So the chart on the left here just shows you how the portfolio splits across the different yield buckets, and the preference shares are that blue bar on the right-hand side. So they sit there, all of them delivering over 6% dividend yield, which is a fantastic high yield. It's also a very safe yield. They don't deliver capital growth, but you know that income is going to be there. And what that means is that when we get high income out of them, but it also means that the rest of the equity portfolio can be nicely diversified across the market. So we're not trapped chasing high risk, high yield stocks. We can hold some dividend growth names, we can hold some genuine growth names, and therefore make sure that the overall total return as a combination of income and capital growth remains pretty compelling. That's allowed us to grow the dividend per share steadily over the last 5 years, as you can see in the chart in the top right, and we're very much on track to continue to grow dividend per share again this year. The dividend yield you can see on the bottom right, and we've maintained this very consistent yield premium to the market over the last 5 years as well. If we look at performance, we tend to think less about the benchmark because we're more of an 80-20 portfolio with 80% equities, but performance over the long term has held up versus an equity benchmark while delivering significantly superior yield. And over the last 6 months, we have a September half year, so we've just reported that, or just about to publish it. You can see that net asset value growth of 15% is ahead of what the market has returned. So a good period for the trust as well. So moving on to what's happened in markets this year. And like I say, it's been a super interesting year for markets. There has been a lot going on and a lot of single events, which I think in any one year would be a major event. But one thing stood out this year, which was really the introduction of tariff policy in the US, which was a genuine change in the kind of market narrative and the balance of trade within global economies. And if you look at the way markets traded, as shown in the chart here, around April, there was this really big dip in market performance. Everything went back. And I think the perception for professional investors was actually, this is a real negative event, which is going to stop markets going up. Actually, we were all wrong, of course, and markets have continued to be super strong through this year and definitely surprised positively. So you can see the performance in sterling terms on the right-hand side there. Emerging markets have done well, which I think is what you would probably expect in a fairly growth environment where the dollar is weakening. Europe and the UK have done very well, almost 20% returns year to date, which is excellent. And although the focus is very much on the US at the moment and US exceptionalism, the S&P 500 has only done 10% in sterling terms because a weakening dollar has really eliminated a lot of that positive return there. And I think if we went back a year, we would have been saying, expect broadening out, expect other markets to perform as well as the US. That has definitely played out, but maybe the currency impact doesn't make that as quite as apparent as it would be otherwise. If we think about trade policy and President Trump's tariffs, then that dominated the market. And perhaps the surprise is that markets have come back so strongly when actually tariff levels, as shown in the left-hand chart here, have remained very high. It's been very volatile, policy has been very fluid, and it's changed a lot, but we've settled with this level of around 15% baseline tariffs at the moment. So a really significant cost for importers into the world's #1 consumer market, and a big change in the balance of trade going forwards. But what we are starting to see now is at least the uncertainty has come down. So the chart on the right shows you economic uncertainty index and trade policy uncertainty index over the long term. And what really stands out is this spike we had in April, a really unprecedented elevation in the level of uncertainty in financial markets. And of course, one thing markets hate is uncertainty. That has now started to come back down. It's still a bit elevated, but it's back in the level where market practitioners and companies can at least predict roughly what is going to happen over the next few years and plan accordingly so things can move forwards. Our suspicion, however, is that probably as we go through time, this tariff policy will put some strain on the US economy, which will become apparent as we move forwards. Of course, that leads into I think the number one question for most investors at the moment, and what has been very much in focus in the last couple of weeks, which is, do we have a bubble, particularly in the US Mag 7 large cap tech stocks at the moment? And when we put this together a couple of weeks ago, the view was probably that we're not in bubble territory. And the reason for that is because in that subset of stocks, actually earnings have been very strong. They have justified this extreme outperformance over recent years. And generally that's true for US stocks. If you look at the left-hand chart, the US companies have continued to beat earnings expectations pretty consistently by over 5% each time they report. And that delivery of consistent earnings upgrades has actually supported the market in a fundamental way. And you can see on the right-hand side for the Mag 7 there, share price performance in the black line has really accurately married with earnings upgrades in the blue line. So earnings does support valuations here. It's not as if we're in the kind of crazy bubble valuations that we saw in the dot-com bubble back in the early 2000s, which is what most people compare this to. So there is genuine fundamental support for the value of these stocks. But that doesn't change the reality, I think, for a lot of people, that market concentration is extremely high. So we have a market where allocation to the Mag 7 has continued to grow. It's around 35% of the US market on the left-hand chart there. And if you look on the right-hand chart, you can see in total financial asset allocation, the allocation to US equities in that black line has become this really high level, really extreme level of equity allocation. And when you have a lot of money in equities and particularly concentrated in a small number of stocks, then the risk goes up and the bar that you need to move those valuations higher goes up as well. So having argued for broadening out and to look at other markets at the start of this year, we still very much feel that is a trend to follow into next year, even though it has performed well this year. And of course, when you look at other markets, we're going to talk about the UK because that's our market. It stands out still from valuation terms. Everything has re-rated this year. We can't say, I think, overall that equities are cheap. But if you look at the main markets compared to their valuation history on a price to earnings multiple, you can see that on the left-hand chart here. The US is all the way over on the left-hand side. It's trading at 21.5 times next year's earnings. And if you look at the historic range, it is off the top of that range and well above the kind of interquartile range that you would see in the blue shaded area. The UK, the poor UK, is all the way over to the right-hand side, and on 13.4 times earnings, it is at a significant discount. And although it sits at the top of its interquartile range, compared to other markets, the UK looks very reasonably valued. That's also the case, particularly when you look at it compared to the returns it offers. And the return on equity by region is shown on the right-hand chart here. The US is delivering exceptional return on equity at the moment, and that supports the valuation as we've discussed. But actually, the UK is there above Europe, above EM. It's doing pretty good returns at 15%, and that's just not captured in the valuation, which is why the UK looks particularly attractive to us. It also remains absolutely the best place for equity income generation. The chart on the left here just shows you the yields, the total distribution yields on offer by country. The FTSE 250 and 100 are up the top there. And although that yield has shifted in its makeup a little bit towards buybacks and away from ordinary dividends, the distribution you're getting from companies remains really compelling compared to other markets. And although that distribution to buybacks, I think, changes the cash dynamics slightly, what we've seen post-COVID is that's allowed companies to reset dividend payout ratios. So if we look pre-COVID, companies paid out about 2/3 of their earnings in dividends. That's been reset to around 50% post-COVID. So the margin of safety on that dividend yield you're getting from the UK is actually much higher as well, which is something we like. So turning on to what we're doing in Shires in the portfolio. The slide here, apologies for a slightly complex slide, but this gives you a really good snapshot of how we are positioned in a big picture sense and our style exposures we're taking. So reading quickly from the left, the light blue bars show you we are overweight value. The dark blue bars show you we are very overweight on yield. That won't surprise. We're going for a premium yield. And it's important to us that we have high yield, but also that we have high dividend growth, which is shown in the first green bar there. The green bars are growth, and we're kind of balanced on that, slightly overweight growth. Purple is quality, and we give up a little bit of quality to have high yield and value exposure. Mostly that's in taking on more cyclicality, because in a closed-end trust, we're not forced sellers. We can hold cyclical stocks, and we think that's actually often a really good source of value within the market. Then the yellow bar shows you size, so we are overweight small cap versus large cap. And the grey bar, if you go over to other, shows you we are overweight domestics versus internationals in the UK. So that's a very broad snapshot of how we're positioned at the moment. And I'll talk through each of those factors quickly about why we're looking that way at the moment. Value is something that we don't go for all the time. We have quite a style agnostic approach. But maybe about 3 or 4 years ago, we shifted from quality growth into value because we were very much of the view that that was where there was better returns in the market at the moment. And you can see the chart on the left here, which shows you the balance of world equity performance value versus growth over the long term. And what you've seen going back in history to the 70s and much before that actually is that value is generally outperformed. But during the period of apologies for the fire alarm. During the period of very low in falling interest rates post the global financial crisis, growth outperformed really strongly. That's what you expect in a low interest rate world. With interest rates higher and normalized now, we expect that value outperformance to again come back, or at least the star balance to be much more balanced than it has been in the past. So that's where we're looking for value. And in the UK market, what you find is a really good exposure to that value factor, split between cyclical value stocks like energy, financials, and materials in the top right of the bubble chart on the right-hand side, or much more defensive value like utilities, telecoms, and real estate in the top left there. So we have very good access to those value sectors in the UK, which makes it attractive from that point of view. Why we're overweight small and mid caps in the UK, again, this has been something that's been a little bit out of favor, particularly this year. We've seen a rotation into large caps. But actually, we think that's really underappreciating the strength in UK small and mid caps. Generally, what you see is the small and mid caps do better long term, but when rates rise and there's concerns about the UK domestic economy, large caps do better. So the chart on the left just shows you large cap versus small cap, and that's the black line. You've seen large caps outperforming as the black line goes up. That's very linked with what's happening to UK bond yields in the blue line there. What's unusual at the moment actually is that underlying economic conditions are actually better than people think. So the UK PMI, you can see in the blue line on the right-hand chart, is going up again. Actually, companies feel okay about things. In that scenario, usually UK small and mid caps outperform, and we're seeing UK small and mid caps deliver good earnings growth and good fundamental returns, but it's not being reflected in valuations. So that's definitely a place we see a lot of value at the moment. The market does remain very concerned about UK domestics, and as we come into the budget next week, I think it's absolutely front and centre. Until we clear that event, it's unlikely we get a return of confidence in the UK economy, but we would see the concerns as being somewhat overdone. And if you look at UK GDP, actually on the left-hand chart there, it's held up pretty well. It's grown. Recent revisions have been positive. So that economic growth has been decent, and it's been better than Europe, for example, but lagged the US. That's what we'd expect given the economic makeup of those countries. But there's no disaster here, despite what you might read. And while the problem we do see is that the high level of uncertainty means that people are saving more. So the right-hand chart just shows you the savings rate in the UK, and it's ticked back up to a high level even post-COVID, which means that although people have good real incomes and they're getting good pay deals, they're not spending it because they're uncertain. And that's causing some issues around the UK consumer at the moment. So when we look at performance for the half year up to September 2025, then there's a couple of things I'll pull out about what's done particularly well. You can see the top 10 positions in the portfolio here. The first thing is we've got a big overweight position in UK contractors. So you can see Kier, Balfour Beatty and Morgan Sindall here, which have all done very, very well. And that's a great example for us of underappreciated quality in a value sector. You know, historically, this was a very tricky sector with low profit margins and a high degree of risk. But what we've seen in recent years is a lot of market repair there. The companies have rebuilt balance sheets, contract structures have passed risk to the clients rather than the companies, and the outlook for them is really strong because you've got so much infrastructure and utility work being done in the UK. That means their order books are really well supported, and we've really seen that in share prices over the last couple of years. The other area of strength has been financials, so you can see companies like Close Brothers, OSB, M&G and Aviva there all continue to do really well. They're helped by a rising rate environment, but also this is a real value sector where, again, I think the quality is underappreciated, and you're seeing that in returns. In terms of the things that have done less well this year, actually, it's generally been things where we've taken cyclical risk and we've probably taken it a little bit too early. And being too early sometimes sounds like you're trying to be clever. Being too early is being wrong. But in this instance, we go down the list, and Pets at Home, Greggs, Victrex, Midwich are all things that we've bought recently in the last 3 to 4 months where they have still continued to go down after a period of really sharp underperformance. That doesn't change our view that these are going to be good long-term investments, but we just need to be patient and wait for the cycle to turn for those kind of companies to pick up and come through. And I'll talk a little bit more about a couple of those later. So last couple of slides, I think a few examples of the things we've been buying recently that try and capture our thought process about investment in UK equities. And the first thing is trying to find names that are underappreciated quality. At Aberdeen, we talk a lot about quality investing. And there's often this conflict between having high quality stocks, but also having high yield stocks, because generally high quality stocks are quite apparent to the market. They trade on high multiples, and therefore the yields available from them is low. So we need to dig a bit deeper. We need to try and be a bit clever and find things that are good quality, but where the market doesn't quite see that. And a couple of examples of things we've bought recently here. So GTT is a French company which supplies the containment systems for gas tankers. And LNG and gas, international gas, is a growing market. It's a company which has a dominant market position with 100% market share because it's a very high risk to replace it with an alternative, and relatively low cost for the ship owner. So GTT has this incredible market position, which gives them the ability to price reasonably, deliver high returns, and also capture that market growth over time. And you can see in the chart here, we bought it near the end of 2024, and it has continued to perform pretty well with that, with decent earnings upgrades and pretty strong performance. The market sees it as a energy name and therefore cyclical, but actually it's a much higher return on capital, less cyclical business than the market thinks. Another example of underappreciated quality is Safe Store on the right here. Again, seen as being cyclical real estate. It's very, very linked to interest rates in the UK. But our view is actually you have quite a strong market position, good network effect, defensive exposure, and a degree of pricing power within that network, which means actually we've got quite consistent earnings and over time reasonable earnings growth. The only thing that offsets that is higher interest costs. As interest rates start to come down, we'd expect to see the earnings inflect upwards. And from our point of view, trading on a big discount to NAV at the moment, we see it as a really attractive opportunity. The next set of things we look at, particularly I think in Shires, is cyclical opportunities. And having a closed-end structure means, as I said earlier, you're not a forced seller, so you can take cyclical risk. You can own things through cycle, and as long as you try and buy them near the bottom than the top, sell them near the top and the bottom, that's a great source of returns. And a couple of examples here. Serica Energy is a UK oil and gas producer, and I think you would struggle to find a sector of even the UK market which has been more out of favour in recent years than UK oil and gas producers. The combination of higher taxes, lower energy prices has meant it is really difficult. But of course, everything has a price. And Serica is one you can see we bought right at the end of last year. And we took the decision that actually, even with lower energy prices, with high taxation of that industry, the returns on offer from that company were actually pretty compelling, particularly on a cash basis. There was also a good management team doing the right things to fix that business and doing particularly deals in the UK North Sea, which would add value. And it's good to be a company doing deals in an area where no one wants to buy assets and everyone wants to sell them. That's a great way to create value. And that's particularly what Serica has done this year. It's more than doubled this year, and it's been a great investment. So you've just got to time those opportunities right. Greggs is the one on the right, and this is an example of a cyclical name which hasn't worked yet, but where we think it will work. And we actually held Greggs for quite a long time. We sold it in around August 2024, and we bought it back this summer after it had fallen 50%. And the reasons it had fallen 50% were that like-for-likes had slowed down, the UK consumer looks a bit weaker, and it had gone into a period of investment into manufacturing and distribution capacity, which long-term will help returns, but short-term lower the cash flows. Our view is actually that Greggs is a decent quality business. They have a good product offering at the right price point. They have a good rollout strategy. And if we roll forward 3 years, we are going to see quite a meaningful free cash flow inflection as that CapEx period comes to an end. So at 50% cheaper than where we sold it, we're very happy to buy back into that business, tuck it away, and be patient. It appeared on our highest underperformers earlier because it hasn't performed yet, but it's one where I don't need to worry about it for 3 years. I'll look at it after that period, and I think we'll get a decent return out of it, particularly at a very attractive in price. So I think that brings us to the end. That leaves a bit of time for Q&A. For me, I just want to say thank you very much for listening. And to summarize, the outlook for us is that really market levels are quite high. We're getting to a period where we expect markets to broaden out, and we expect income as the component of returns to become increasingly important for investors after a time when you've had really supernormal capital growth. UK as a market is really, really well placed to benefit from that. And Shires as a portfolio offers, in our view, this exposure to resilient high income for the end investor. And I think a really interesting exposure to a broad range of interesting quality companies in the UK market.
Thank you very much, Iain. Comprehensive presentation. We have got a number of questions here, which we're going to dive into for the last 5 minutes. So first question has come in here. I think you did touch on it within the slides. Tony asked, what are the top 10 stocks held within the fund? But I think maybe the question could be here, Ian, is has the top 10 holdings evolved so far this year in terms of stocks you've been bringing into those core holdings, those top holdings there?
Yeah, so the top 10, I don't know if the presentation's available, but you can see top 10 on the slide here in the appendices. And you can see what we hold. Some of those include the preference shares, which are a big weight, so ecclesiastical, nationwide, and they've been pretty consistent holdings over the long term because they're very stable sources of income. The next things down that list, and I tend to look at the relative holdings on the right-hand side of the chart. Most of those have been things that we've held for a while that have done well over the last couple of years. So the contractors we mentioned, also some energy names like Diversified Energy, which is a great source of high yield, and banks like Standard Chartered, which have done great returns over recent years. We like to kind of bring things in maybe in the top 20, but not the top 10, and then grow them over time. So these things are probably things that have been there for quite a while. And turnover for us, we've definitely been more active than we have been in the past. I think it's a market that rewards active behavior at the moment. But turnover is probably about 30 to 35% this year.
Thank you. Thank you very much. Just a note, this is being recorded and the slides are available on the event page at this point in time. I've just had a private message in for that. I've also just had a question in asking for the EPIC code, which is SHRS. So a couple more questions here. Ian, Stephen asked a very interesting question, very timely. How are you positioning for the upcoming budgets?
Yeah, great question. I think it's interesting, isn't it? The way they handle the budget has changed. So now they're very keen to front run everything and get it out there. Expectations, let's say, are so low that it's hard for it to be a negative event. And my expectation would be that the government have learned the one thing they can't do is do any policy changes that are inflationary or move bond yields higher. So the income tax change, which was flagged, I think would have been a good policy. It's a shame they've U-turned on that. But generally, the aim will be to get inflation and bond yields down. Our positioning is very much aligned with UK bond yields over the next year trending down. So long real estate, long mid-caps, long utilities, all those things will definitely benefit in that scenario. And I think if you do get a policy mistake, it will slow the pace of rate cuts, but that upside is still there.
Thank you. Thank you very much. Clifford's put in a question here asking, are there any investments in unlisted securities within the trust? And put in brackets here, ADIJG, which I think refers to another trust within the Aberdeen stable.
Yeah, no, we are only listed.
Thank you. Thank you for clearing that up. Hugo has a really good question here and asks, what have been the main drivers of your outperformance? And you did go through some really good slides there of some of your best performing and underperforming stocks. So it'd be good if you could recap on those. But also, I think it'd be good, Ian, if you could bring in here what you've actually avoided as well. You know, obviously there's weakness out there in the markets, and then avoiding those areas will actually then help that performance as well. So
yeah.
Touch on those.
Yeah, great question. I think we covered some of the individual stocks earlier. I think if I think broadly about what has worked this year, then being nimble and trading around stocks has worked. Having a value exposure has definitely worked this year. And I think just being open to a broad range of sectors has really helped us. Like if we go back, quite a few investors are very focused on quality and growth sectors in the recent history. And that means they probably avoided some areas like banks. But then over the last 3 years, it's been banks that have been the only sector that have outperformed US large cap tech. That's actually been the best sector. So I think being open to fundamental strength across all sectors and valuation opportunities has been what has worked for us in terms of returns. Things we've avoided, just overvalued stocks. That sounds stupid, right? But one of the great things about income investing is that when the yield compresses, you have a natural inclination to sell. And Greg's is a great example of that. When the yield compressed down to below 2% last summer, For us, it didn't quite fit what we were trying to do, so we sold it and moved on. And then when it's much cheaper, the yield is much higher, we can come back in. But that need to have a high yield means we don't get stuck in things that have done well and get to be slightly overvalued.